$45 billion, 400% leverage, a 23-year-old calling the shots. In July 2026, most of it vanished in days. To understand how Leopold Aschenbrenner lost it, you first need to understand why anyone gave it to him. In April 2024, OpenAI dismissed 22-year-old researcher Leopold Aschenbrenner following a dispute over the disclosure of internal security documents. 2 months later, he published a 165-page paper titled Situational Awareness. The decade ahead. The thesis was clear. Artificial intelligence was expanding at a pace that would quickly hit physical limits. Aschenbrenner argued that continuing this trajectory required a massive immediate build-out of specialized chips, high bandwidth memory, gigawatt-scale data centers, and raw power infrastructure. The paper spread rapidly through Silicon Valley, read by executives and investors alike. It framed Aschenbrenner not just as a technical expert, but as a prophet of the physical bottlenecks of the computing age. He had established the intellectual framework. Now, he needed the capital to trade on it. Late in 2024, 22-year-old Leopold Aschenbrenner launched Situational Awareness LP, a Cayman-domiciled hedge fund designed to trade directly on his infrastructure thesis. Silicon Valley's elite quickly backed him. Stripe co-founders Patrick and John Collison, alongside former GitHub CEO Nat Friedman and investor Daniel Gross, anchored a $100 million first close. The intellectual credibility converted to substantial market influence. By the end of June 2026, the fund reported a net return after fees of 439% for the year. Driven by this performance and aggressive structural leverage, the fund's total assets under management exploded, peaking in early July at $45 billion. Aschenbrenner was no longer just an academic theorist. He controlled one of the most powerful capital pools in the AI trade. Aschenbrenner translated his thesis into a highly concentrated portfolio, focusing capital on a few critical assets rather than diversifying. To capture the hardware bottlenecks, he built massive long positions in high bandwidth memory leader SK Hynix and Micron technology, alongside flash storage provider SanDisk. He backed GPU cloud operator CoreWeave and AI infrastructure firm Nebius Group to secure compute access. On the other side of the ledger, Aschenbrenner targeted software companies that consumed massive compute without producing hardware. He shorted these firms, viewing them as structurally vulnerable to soaring operational costs. Adobe became his primary high-conviction short. It was a dual-sided market bet: own the scarce physical infrastructure and bet against the applications reliant upon it. To turn these concentrated positions into a market-moving force, Aschenbrenner introduced a highly volatile element: raw debt. He structured the fund to run on leverage as high as 400%. For every dollar of investor capital, $3 more were borrowed. Wall Street's most powerful prime brokers, Bank of America, Goldman Sachs, and JP Morgan Chase, supplied this debt backbone. Aschenbrenner accepted these terms, tying the fund's survival to strict daily collateral limits. On the way up, this massive borrowed exposure magnified gains. On the way down, it left absolutely no room for error, setting a dangerous trap. July 2026. Broke the trade. A sharp sell-off struck AI infrastructure stocks, tearing through the fund's long book. SK Hynix's new U.S. listing overlapped with a massive liquidation of leveraged retail accounts in South Korea, accelerating the stock's slide. Within weeks, Nebius Group, SanDisk, Micron, and CoreWeave each plummeted by more than 35%. On the other side of the ledger, Adobe rallied, turning the fund's primary short position into a liability. Hit on both sides at once, the fund breached its strict collateral limits, forcing prime brokers to issue immediate margin calls. The cash demands were too large to meet. To satisfy the bank, situational awareness surrendered. In a single, massive block trade, the fund sold its entire public stock portfolio. Griffin's Citadel stepped in as the buyer, acquiring the debt-fueled positions at a steep discount. Within days, the fund's assets shrank from their $45 billion peak to approximately $10 billion. Aschenbrenner later clarified to investors that the fund was not liquidated. His unaudited figures revealed a 67% loss for July. The though the fund remained up 80% for the year. Market analysts viewed the liquidation as a structural warning about massive debt hiding within highly concentrated AI portfolios. The sudden collapse raised immediate questions about liquidity mismatches, counterparty risk, and credit exposure across the dozens of AI-focused funds founded during the recent boom. On CNBC, Jim Cramer characterized the forced selling as a clearing event that potentially marked a bottom for the broader AI market sell-off. But for the shadow banking system supporting these funds, the episode revealed how easily a localized margin crisis could cascade across global markets. This collapse is a stark warning of the volatility hiding beneath the AI boom. When the next margin call comes, who survives? Subscribe for more.